We have R. Sreesankar of Prabhudas Lilladher now with us. Sri, you have been looking at NBFCs for really a long time. Do you think recent correction is one of the buying opportunities into this sector?
It is worth looking at, but we should not forget that there is an element of uncertainty which has crept in due to the disruption on account of the demonetization. So I don't think if any one of the banks or NBFCs are able to put in a number to it, when the things will start to recover, when they will start to see an improvement in the asset quality because of these demonetization impact, there is bound to be some asset quality issues also coming up for many of these companies. So I think there is an issue out there. But again, I don't think these things are going to be permanent. It will get adjusted. And as you rightly put it across, the price corrections should be taken as an opportunity to look in at least some of these companies.
Which of your NBFCs, microfinance or housing finance companies would now be under the top pick?
See, it's too early to go and have a comment on which are going to be the companies. I don't think the fundamentals of any of these companies have not changed. You still have companies which over there. See, look at you yourself are talking about Ujjivan correcting from 450 down to 285. Here are companies, Mahindra Finance has corrected from all the way from 400 to around sub 250 levels earlier. And you're seeing these corrections. So the point is the corrections are brought about by some profit booking in these counters also. So we see a continued level of selling which is happening right now, and that is also impacting. Now, if I give a number to it, which is none of these stocks have gone into our topics right now. We have in the financial services, we do not have any NBFC in our topic. And it's definitely some time, probably with the quarterly results, third quarter results out, you may have a guidance coming from them on the asset quality and where they see themselves. And I think that will be a better opportunity when the clarity comes in to look at it.
In terms of Q3, do you think that numbers may not be that important? Q4 and what's the guidance for FY18 is something that Street will focus on?
See, Q3, November, let's put it, Pankaj, let's put it certain things in perspective. As an analyst, my own expectation was what? I was thinking that the impact of demonetization would have been severe in the month of November, and it should have improved in the month of December. And from January onwards, things should have been much, may not be back to normal, but near normal. But what has actually happened? November, as we expected, was a washout. But we have not seen much improvement in December. December continues to be very similar in vein with what is November. So that has resulted in probably that from January onwards, the liquidity not being available in terms of availability of cash, there is some disruption which will continue to happen in January also. Which means that you probably had your third quarter performance getting impacted and your fourth quarter performance also getting impacted. So that's the environment that we are in. So I would think that obviously FY17, you've had an earnings growth of around 30% coming from banks alone. That may not materialize, so financial services companies. Now, go back to FY18. So you're actually starting FY18 at a level, you're going to question yourself. Are you going to see the kind of faster growth that you anticipated in FY18 going to be still there? And if you get an indication saying that that is going to be there, and I think we'll be expecting it to be lower, so you have got a story to say. So FY18 clearly, by when in FY18 you actually expect to see things improving significantly, that's going to be the key.
Urban recovery or recovery into banks could be faster because urban markets could see a better credit offtake earlier than the rural markets?
See, my view about credit offtake still remains the same, and I think as long as the credit offtake has got different parts, multiple parts. There is one part is effectively your project finance. Second part is your infrastructure funding. Third part is your retail and consumption oriented. Now, I do not think that the project loan part of it is not going to see any significant improvement in the near term. That's simply because in the capacity utilization of the Indian industry still remains at lower, at 70% or so. So if your capacity utilization is lower, it's difficult for me to fathom that you actually start to see large amount of capex programs initiated by corporates. That's not going to happen. So that's a bit of an iffy. The second part is on the infrastructure side. Infrastructure side, again, there is a lot of HAM projects with the hybrid annuity projects on the roads, on EPC, etc. So those projects, as government is funding it, and government keeps on coming over to these new projects and so many kilometers of road to be built, etc. That continues to remain on the positive side. So you will see a credit offtake from that point of time. The second is the third is a retail one. So for the consumption basis, etc. So the retail growth is still going to be much stronger. So that retail growth is where probably we'll see a better offtake. But let's look at the credit growth numbers. It has been one of the lowest that we have seen for the last so many years. And I think it has not seen a significant increase. So the chances of deposit growth outsmarting credit growth yet again in next year is on the higher side. So you have a situation wherein the banks also invariably who fund a lot of this corporate finance, especially the PSU banks, may not be doing exceedingly well from a corporate credit point of view growth.
Apart from NBFCs, any other mid-cap top picks that you have after the recent correction? Are they even looking more attractive?
See, Pankaj, I do not get into this topic immediately after the correction that we change our topic. We try to get our topics on a consistent basis. So we still have in the month of December, among our topics in the mid caps, Indraprastha Gas, Jubilant Life Sciences, XMA Technologies, Sadbhav Engineering, Rallis, Thyrocare, NIT Technologies, Navneet Education, VRL Logistics, etc., and also SpiceJet. It is the airline is an industry where we have actually seen a cost push which has happened suddenly because of the crude prices have gone up and consequently the ATO prices have gone up. So that's somewhere which we need to be a bit more careful on how the crude price is going to behave, because we still are comfortable with a strong PLF or utilization that we have seen in terms of aircrafts, and the capacity utilization is extremely good. But the way how the raw material price is going to move is going to determine to a great extent how the pricing environment and how the profitability is going to be.
Among your top picks that you mentioned, Indraprastha Gas and Thyrocare Technologies are names that have not corrected. In fact, they have only rallied from their recent lows or in the last few months. Still they are looking attractive. This is not something which has come up new in the topics. It has been there for quite some time. Thyrocare is an initiating coverage which has got added. We're comfortable with it. We still believe that it's going to be a strong growth story. And in fact, demonetization is not something which is going to impact Thyrocare to that extent. So the Thyrocare and Indraprastha Gas, Indraprastha Gas, etc., are companies which may not have a huge impact due to this demonetization, and the growth story still remain intact. We still like it. But now the next point, Pankaj, what happens is when the price correction of a lot of NBFCs and everything, now the relative valuation starts coming in. And I don't think an NBFC is in the same sector as a Thyrocare or for that matter, Indraprastha Gas. But when the price correction happens, some of these stocks starts to look quite attractive from a 24 months perspective. And so you probably will end up seeing sector rotation or a stock rotation in terms of an investments by people, by institutions. That's where some of these underperformance will actually start to creep in from later. But at the moment, we still like Thyrocare and Indraprastha Gas. I was also looking at your large cap picks, and there seems to be no metals or steel name into that. Is that because these stocks have rallied recently?
Not really. First of all, we do not believe that the demand environment for the entire metal pack, for the commodity pack, has turned around. That's number one. Number two, it's expected that China probably will have a lower economic growth next year than what we had in the current year. If that is the case, the reasoning for commodity prices to remain much more firmer doesn't happen, and there is no logic to the commodity prices remaining pretty high. And point number three, we believe that the rally in commodity prices happened because there has been some shutdown of inefficient capacities. Now, that's also not going to be quite sustainable over a period of time. And that's the reason why we don't have some of the commodity stocks out there.
Sri, thank you so much for taking out time for us. Always a pleasure.